Oil prices are hovering around a 7-year high, with West Texas crude topping $80 a barrel this week. But there is a lot less drilling going on than the last time prices were this high. As my next guest explains, that's because the big players are not investing in production anymore, thanks in part to the ongoing ESG push, leaving the surging market to smaller producers who can't keep up. He says banks are also reluctant to make energy loans, compounding the problem. And he's not just covering oil. He's also written the upcoming book, A Shot to Save the World, following the race to develop a COVID-19 vaccine. Joining me now is Gregory ZUCKERMAN with the Wall Street Journal. Greg, welcome back.
Hey, great to see you, Kel.
And congrats on the new book. And I loved this piece this week, which I think really explains to people why there's not going to be a massive supply surge. Before we get into the nitty-gritty, do you think this means that oil prices might remain at these elevated levels for quite some time?
I do. So I've been covering these markets and some of these wildcatters, frackers over the years, and never thought I would see this kind of change where they're focused on dividends, cash flow. It used to be all the production. They used to talk a big game about returning capital. They never did. And now they are. There's all kinds of pressure on the part of investors, and it seems like they've changed. We're talking about the public companies, the big companies. So as a result, the privately held companies, drillers and such, are much more important. And they just are not big enough to really step in here and help us out.
Right. And I think that, it's important to mention that while the ESG trend is very important, we have a decade of terrible returns for a lot of these drilling activities, whether oil and gas, shale. It comes on top of an already. Is that why the banks are so reluctant? Of course, they're worried about ESG on the one hand, but on the other hand, because it hasn't been historically a great return on income, on return on their loans, I mean.
Yeah, that's exactly right. So in some of them, I think both lenders and investors are sort of hiding behind maybe ESG, giving that as the excuse or the reason. But they've been unbelievably awful returns. But now should be the time they're stepping up, and they are feeling these kind of ESG kind of pressures. Some of them are heartfelt, and some of them are sort of virtue signaling, I would think. And sadly, we're not ready yet to transition. We still get 80% of consumption comes from fossil fuels. So it's coming at an awful time, this production issue, the challenges in terms of production, and we just don't have the private capital out there. There used to be tons of, as you know, private equity firms that were interested in energy and investing in energy, about 29 or so just a few years ago, and today is just 9. So the private money is just not there.
Yeah, and I've seen other publications saying that, private equity is, pumping up oil prices right now and all of that. And, okay, maybe relative to zero, but, it's certainly nowhere near the levels it once was at. Do you think this discipline remains, though, Greg? I mean, here's the sort of fundamental irony. If this remains the case and the oil price remains higher, then ultimately you're going to have to get more players in the market. I mean, it's so hard to maintain an equilibrium at a higher oil price. I wonder if this time really will be different.
Listen, when it comes to commodities like energy, high prices solve high prices historically. So you do think over time, you got to figure there'll be opportunities. People will step in. The Blackstones and the other kind of big private equity firms and other types of investors will shift. And we need them. I mean, frankly, it's a regressive tax. When energy prices go higher, it's the underclass, it's the people that really can't afford both at the pump and to heat their home that get hurt the most. So we are going to need more investment, both in alternatives, but in also fossil fuels, sadly to say.
Absolutely. And I think we're talking 15% of income if you're in sort of the bottom 10% of earners. And we know that, so this is on the gasoline side, on the oil side. On the natural gas side, the spikes are even worse, maybe a little bit more contained in the U.S., but probably a 30% increase in heating bills after this weekend. Oil and gas are linked, obviously, because of the way that they're fracked. So do you anticipate, any kind of supply change in the U.S. where we could end up going from this shortage to a glut at some point, or no?
Well, it all depends, obviously, on the global economy. If you argue that China is going to slow, then maybe globally we have sufficient amount of oil. And all projections sort of suggest that we're going to grow our consumption, our need or demand for oil over the long term, but very slowly. We're talking maybe 1% a year. So you could see potentially a surge. And people like, Harold Hamm, Continental, I'm sure they're itching to increase production. But until now, they felt this real pressure from investors, and for the first time I've ever seen it, they're heeding that pressure.
Yeah, absolutely. Greg, thanks so much. Again, there's just great stats in this piece. I highly recommend it. Gregory ZUCKERMAN joining us from the Wall Street Journal.